Dutch Lady Milk Industry Berhad is a leading dairy company in Malaysia that produces and distributes milk and dairy products such as infant formula, yogurt, and juice. It was established in 1963 and is owned by Friesland Campina, a Dutch multinational dairy cooperative. Dutch Lady's purpose is to nourish the planet and people in every stage of life with quality dairy nutrition. Products are certified halal by the BBARMT3C and other relevant authorities.
7-Eleven, a global convenience store chain, was founded in Dallas in 1927 and is currently owned by 7&I Holding Co. The chain operates 24/7, selling snacks and essential home goods. It prioritizes convenience, supply chain effectiveness, and constant innovation to meet customer demands and preferences.
Next is methodology. The first one is objective. Evaluate and compare the financial performance of these two companies. Analyze liquidity, solvency, efficiency, and valuation of the companies. Second one is data collection. Main source of data is official annual reports of Dutch Lady Milk Industries Berhad and 7-Eleven Malaysian Holdings Berhad. Prioritizes consistent data collection for reliability and accuracy. And the third one is analytic framework. Structure around financial metrics and ratios. Profitability ratios provide information about profitability and returns. Liquidity ratios assess short-term obligations. Solvency ratios evaluate long-term financial stability and debt management. Efficiency ratios analyze operational effectiveness and asset management. And valuation metrics provide insights into market perception, intrinsic value, and investment attractiveness.
Trend analysis is used to compare ratios over the years and determine which year has a better ratio for a company. Profitability ratios offer valuable information about a company's overall profitability, and profitability ratio also contains 5 elements, which first, gross profit margin, second, operating profit margin, third, net profit margin, third, return on assets, and lastly, return on equity. In this slide, show the trend analysis of the gross profit margin for Dutch Lady Milk Industries Berhad and 7-Eleven Malaysia Holdings Berhad is presented for the period from 2018 to 2020. The gross profit margin is a measure of how effectively a company manages its expenses to generate profit. In this graph shows that the highest ratio was Dutch Lady Milk Industries Berhad in 2018, which was 39.70%. It showed that the company effectively managed expenses to generate profits, while the lowest ratio was 7-Eleven Malaysia Holdings Berhad, indicating a decline in this ability, as much as 39.83%. Next is the operating profit margin. Is a measure of profitability that shows how much profit a company earns from each RM of sales after subtracting costs. For most businesses, an operating margin higher than 15% is considered good. So this graph shows that Dutch Lady Milk Industries Berhad's operating profit margin was a sudden increase to 25.10% in 2021, which was 16.24% higher than the previous year. Meanwhile, 7-Eleven Malaysia Holdings Berhad operating profit margins, the highest ratio in 2022, increased to 3.74. As a result, the Dutch Lady's financial health is way better than 7-Eleven. Other than that, net profit margin will vary considerably by industry and size of business, but as a general rule of thumb, a 10% net profit margin is considered average and 20% margin is considered high. So in this graph, for Dutch Lady, as much as 21.87% of the net profit margin gained in 2021. The company in generating its profit among those 5 years, as a high net profit margin is usually viewed in a positive light. For 7-Eleven Malaysia Holdings Berhad is not in good ratio performance. This is because fluctuations in net profit margin may be influenced by changes in revenue goals. Next is return on assets. Is a metric used to evaluate how efficiently a company can generate profit with the assets it has available. So in this graph, we can see that for Dutch Lady Milk in 2021 shows the highest rate of return compared to the 5 years, which was 35.57%. The return on asset for 7-Eleven Malaysia Holdings Berhad was 6.90 in 2018, was the highest rate. So these changes in return on assets could be influenced by changes in the company's asset composition, such as new investment or divestments, which can impact the overall ratio. The last one is the return on equity that measures how profitable a company's investment is for its shareholder. In this graph, we can see that in 2018, Dutch Lady Milk Industries Berhad had a return on equity of 122.75, while 7-Eleven Malaysia Holdings Berhad had a ratio of 55.90%. That indicates that we can know that the investor in both companies received the higher dividends in the same year, reached 2018 due to the higher ratio. Liquidity ratios are financial metrics used to measure a company's ability to meet its short-term obligations using its most liquid assets. They provide insight into a company's short-term financial health and its ability to manage its working capital effectively. Liquidity ratios contains two elements. First, current ratio, and the second, quick ratio. A desirable current ratio is between 1.2 and 2, indicating that a business has enough current assets to cover its debt. If the current ratio falls below 1, it means that the company does not have sufficient liquid assets to meet its short-term liabilities. So among the years 2018 to 2022, for Dutch Lady Milk in 2021 show a favorable financial ratio that suggests a lower risk and a better year for Dutch Lady. Meanwhile, in 7-Eleven Malaysia's Holdings Berhad has consistently poor ratios over the past 5 years. It is indicating potential difficulty in meeting its current obligations. Next, the quick ratio that represents the amount of short-term marketable assets available to cover short-term liabilities, and a good quick ratio is 1 or higher. A number less than 1 might indicate that a company doesn't have enough liquid assets to cover its current liabilities. We can see that Dutch Lady, their quick ratio into the 2021 is good. It is because the lower risk and a better financial year compared to previous year. However, for 7-Eleven, their quick ratio in the past 5 years has been consistently below 1. It is indicating potential difficulty to meet their current obligations. The leverage ratio, basically leverage ratios measure the extent to which a company is using borrowed money, which is debt, to finance its operations and investments relative to its equity. Leverage ratios contains 3 elements. The first one is debt ratio, second one debt to equity ratio, and the third one time interest rate. The first one is the debt ratio that paints a picture of a company's assets financed by debt. A ratio close to 1 suggests the company is heavily reliant on borrowed. So basically, a high debt ratio might make investors cautious as it implies greater financial risk. Based on the graph show, in 2021, Dutch Lady Milk had a good financial ratio that indicating a lower risk of indebtedness. Similarly, in 2018, 7-Eleven Malaysia Holdings Berhad also had a lower debt ratio. It showed that both companies' stability with a lower amount of debt. The second one is the debt to equity ratio, how much debt a company has for every ringgit of equity. Higher ratio indicates that the company is relying more on borrowed funds. According to the trend analysis, Dutch Lady Milk had a favorable debt to equity ratio in 2021. It is indicating a lower risk of indebtedness compared to previous years. Similarly, 7-Eleven Malaysia Holding Berhad had a good ratio in 2018. Overall, Dutch Lady Milk Berhad had a better debt to equity ratio than 7-Eleven Malaysia Holdings Berhad. The last one is time interest earned of Dutch Lady Milk. Their performance in 2018 exhibited a time interest earned ratio of 2.78, making them less prone to bankruptcy. This ratio also indicates their ability to fulfill interest obligations. In comparison, 7-Eleven Malaysia Holdings Berhad had a time interest earned ratio of 2.75 in 2021, which also demonstrates a good financial health.
Efficiency ratios, also known as activity or turnover ratio, assess a company's ability to use its resources to generate sales, manage assets, and convert inventory and receivable into cash. Ratios provide information about the company operation efficiency, assets management, and productivity. There are 3 ratios under efficiency ratio, which is asset turnover ratio, second, inventory turnover ratio, and account receivable turnover. For asset turnover ratio, a higher asset turnover ratio is indicative of a company's superior ability to utilize its asset in generating sales. A lower ratio suggests a lack of efficiency. For Dutch Lady Milk Industry Berhad, the year of 2018 witnessed the highest asset turnover ratio, surpassing other years by a significant margin of 2.63 times. Similarly, 7-Eleven Malaysia Holdings Berhad also experienced its highest ratio in 2018, outperforming previous years by 2.87 times. The inventory turnover ratio is a financial metric that measures how many times a company's inventory is sold or replaced over a specific period within a year. It is a crucial indicator of a company's operational efficiency and how well it manages its inventory. In the inventory turnover ratio for Dutch Lady Milk Industries Berhad is lower than 7-Eleven Malaysia Holdings Berhad by 5.12 times. It shows Dutch Lady Milk Industry Berhad has less effectiveness in generating sales from inventory than 7-Eleven Malaysia Holdings Berhad by 6.27 times. Account receivable turnover ratio is a financial metric used to assess how well a company manages its receivable. It indicates how many times a company collects its accounts receivable on average during a given period. For 7-Eleven Malaysia Holdings Berhad shows that the company had higher by 6.5 times than Dutch Lady Milk Industry by 3.75 times. In account receivable turnover, this indicates Dutch Lady Milk Industry Berhad had higher effectiveness in collecting its receivable. Valuation ratios are financial metrics that are used to determine the relative worth of a company's stock or other financial instruments. This ratio assists investor and analytics in making informed decisions about whether an investment is overpriced, underpriced, or fairly valued. Fundamental analysis, which involves evaluating a company's financial health and performance, makes extensive use of valuation ratios. There are two types of valuation ratio, which is price to earnings and price to book. For price to earnings, widely used financial metrics that evaluates the relative value of a company's stock by comparing its current market price per share to its earning per price (EPS). It is a key indicator for investors to assess the valuation of a stock and makes informed investment decisions. In 2018, Dutch Lady Milk Industry Berhad and 7-Eleven Malaysian Holdings Berhad had the same valuation ratios for the price of earnings. It shows both of the company often implies the investor have high expectations for the company's future growth and profitability. Last but not least is price to book, or PB ratio. It's a financial metric that compares a company market price per share to its book value per share. It is a valuation ratio that provides insight into how the market values company relative to its accounting book value. Dutch Lady Milk Industry Berhad had higher valuation ratio by 34.1 than 7-Eleven Malaysia Holding Berhad by 60.5 for the price to book. It indicates that Dutch Lady Milk Industry Berhad may have received higher demand than 7-Eleven Malaysia Holdings Berhad.
Cross-sectional analysis. A. Profitability ratios. In 2018, Dutch Lady Milk Industries Berhad exhibited superior performance in gross profit margin ratio, operating profit margin, net profit margin, return on assets ratio, and return of equity compared to 7-Eleven Malaysia Holdings Berhad, indicating better performance in terms of profitability ratio. B. Liquidity ratios. In 2018, Dutch Lady Milk Industries Berhad demonstrated superior short-term obligation payment efficiency and inventory management compared to 7-Eleven Malaysia Holdings Berhad, as indicated by its higher current ratio. C. Leverage ratios. Dutch Lady Milk Industries Berhad outperformed 7-Eleven Malaysia Holdings Berhad in terms of debt ratio, debt to equity ratio, and times interest earn ratio, indicating lower risk for shareholders. Next, D. Efficiency ratios. In 2018, Dutch Lady Milk Industries Berhad had lower asset turnover ratio, inventory turnover ratio, and account receivable turnover compared to 7-Eleven Malaysia Holdings Berhad. Lastly, valuation ratios. In 2018, Dutch Lady Milk Industries Berhad and 7-Eleven Malaysia Holdings Berhad had similar valuation ratios for price to earnings and price to book.
The conclusion is, after analyzing the financial statement, it is clear that Dutch Lady Milk Industry is more financially stable and successful compared to 7-Eleven Malaysia Holding Berhad. It is mainly due to the strong consumer preference for Dutch Lady products and their responsible financial management. Other than that, 7-Eleven Malaysia Holdings Berhad faces higher risk and may struggle with managing expenses effectively. Dutch Lady also has a better reputation and consistently generate higher profit, making it a more attractive investment. However, both companies has growth opportunities and challenges that need to be addressed.